Ever wished you could protect your stocks from falling? Or maybe even make a profit when the stocks are falling? That's exactly what put options lets you do. Hi, I am Pranav, an NISM certified trader and trainer, and you're watching Stockshaala by Kotak Securities. And today we are going to discuss about something that's going to flip your understanding about the markets, because put options is something most beginners don't even know that exists. So let's keep it super simple and understand what exactly is a put option. A put option is a financial contract that gives you the right but not the obligation to sell a specific stock at a specific fixed price called as the strike price and within a specific fixed date called as the expiry date. Let me give you a real life example so that you can understand this concept better. Now I have this phone with me which costs around 1.5 lakh rupees. Now I'm scared that it might break or even lose value over a period of time. So what I'm going to do is I'm going to buy an insurance for rupees 2000 so that even if the phone breaks or if the phone loses value, the insurance company is going to pay me back the original price of the full phone. That's exactly what a put option does to your stock. If the price drops, then the put option premiums gains value, and that's exactly how it acts like an insurance against losses. And here's the best part. You don't even have to own this phone to buy that insurance. Instead, you can directly buy the put options of that specific stock and speculate on it to make a profit. Here is an amazing fact about put options. During the 2008 financial crisis, smart traders who bought put options made millions by betting on falling banks. In fact, put options are called as the crash insurance in the market world. So when exactly do traders use put options? You can use put options for multiple reasons. Number one, let's say you own a stock and you're scared that the price might fall, and that is when you use a put option to hedge your position. Second, even if you don't own a stock, you might want to profit from the fall of a specific stock. That is when you can enter into a put option contract. And finally, you can also use put options to create strategies like spreads or straddles. Imagine you own 100 shares of Infosys, which is trading right now at rupees 1500. You are very bullish on the long term, but there has been some news in the short term because of which you expect the price of Infosys to dip in the short term. So what do? So you buy a put option of strike price 1480, which is a little lesser than the actual price of Infosys, by paying a premium of rupees 20. And the lot size is 100 shares, which means you're going to pay 100 into rupees 20, that is 2000 rupees, to buy this option contract. Now there are two scenarios that is possible. One scenario is that the price of Infosys is going to fall, and the other scenario is that the price of Infosys is going to rise. Now let's discuss these scenarios in detail. Now let's say, for example, considering the first scenario, if the price of Infosys falls from 1500 all the way down to 1400 rupees, then in that case, you're still going to exercise the put option and sell Infosys at 1480 rupees, even though the price has fallen to 1400. So let's analyze the P&L in this specific situation. Since the price went from 1500 to 1400, you're losing rupees 100 on every share. But since the premium gained value, it has gained 80 rupees, which means the total net loss for you is rupees 100 minus rupees 80, that is only rupees 20. In the original situation, you would have lost the entire 100 rupees, but whereas since you bought this put option and the premiums gained value, you're losing only 20 rupees. So basically, the loss is minimized and your portfolio is protected. Now let's look at the second scenario where the price of Infosys rises to 1550 rupees. In this case, the put option will expire worthless, but your actual stock has gone up, which means the 2000 rupees which you paid as a premium is going to be just like an insurance fee. It's just like wearing a raincoat. If it rains, then you're still dry and protected, but whereas if it doesn't rain, then you just carry it around and you're still happy. So let's do a quick recap of what we have learned so far. We have learned that put option is a financial contract where you have the right but not the obligation to sell a specific stock at a specific price and within a specific date. We also learned that put options gives you the right to sell, just like how call option gives you the right to buy. Put option contracts can be used as hedges to protect your portfolios or even speculated for a profit. And finally, put options can also be used to create strategies like spreads or even straddles. So if you like this video and understood what exactly a put option is, then go ahead and share it with your friends, because we are going to be covering put option buying and selling in complete depth and clarity. You're watching Stockshaala by Kotak Securities, and I'm Pranav VK, and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.